to Iron Financial, where we forge stronger portfolios and we cut through all the market weakness. Today, we are putting Equinix on the anvil. Now, this is a company that sits at the absolute epicenter of the digital world. They provide the physical infrastructure. We're talking about the actual data centers that power pretty much everything, from cloud computing all the way to the AI revolution.
You know, the AI hype, it's just everywhere you look. It's this massive tidal wave of cash and big ideas. But you know what? Hype doesn't pour concrete. It doesn't build a solid foundation. So that's what we're here to do today. We're going to look for the cracks in the armor of Equinix. That's ticker EQIX. Look, everyone's trying to sell you the picks and shovels for this AI gold rush, right? But some of those shovels, they're just cheap tin. They'll bend on the first rock. Our job, what we do here, is figure out if Equinix is selling you shovels made of hardened forged steel or if they're just another company peddling cheap tin to hopeful prospectors.
All right, let's lay out the blueprint for today. First, we're going to establish exactly why Equinix is considered the premier AI infrastructure play right now. Then, we are going to forge the bull case with hard, cold numbers before our skeptic here starts tapping the walls and searching for cracks. After that, we'll stress test that dividend bedrock, we'll unpack the whole REIT complication, and trust me, it is a complication, and then we'll deliver our final Iron Financial verdict. Let's get to work.
Right. Every single digital revolution needs a physical home. You have to remember that. Code doesn't just exist in some mystical cloud. It runs on actual servers, sitting on actual racks, inside massively cooled, highly secure buildings that are sucking down enormous amounts of power and connectivity. Equinix is claiming to be that home for AI. They're positioning themselves as the indispensable landlord for this entire new digital economy. So let's see what the leadership is actually saying about where things stand right now.
Okay, so that's a very bold statement from the CEO, Adair Fox-Martin. But look, in this market, talk is cheap. C-suite optimism is basically a requirement of the job. So the only thing that really matters, the only thing we care about, is whether the numbers actually support this narrative. She's out here claiming demand is at an all-time high. Well, let's see if the data proves her right.
And this is where we do the heavy lifting. I want you to forget the narrative, forget the quotes, just for a moment. We are going straight into the engine room. A company's real strength is measured by its ability to generate new business. And for a company like Equinix, the single best leading indicator of its future revenue is bookings. So I'm going to build this bull case for you brick by brick, starting with that exact metric.
Okay, just look at this number, $474 million. That's an annualized gross bookings in just one quarter. You have to understand, bookings are the absolute lifeblood of this business. This isn't some pie-in-the-sky projection. This represents signed contracts. These are new commitments from real customers that are going to translate directly into recurring revenue month after month. So this isn't money they hope to get. No, this is revenue they have already locked in. You can think of it as the raw material for all their future growth. It's the iron ore that's getting shoveled right into the furnace.
And this chart, well, it just brilliantly illustrates the momentum we're talking about. A single number can be a snapshot in time, sure, but a trend tells a story. And what we're looking at here is a 42% explosion in growth year over year. That's not just strong, that is a serious acceleration. We're not talking about a slow build here. This is rapid, powerful expansion. A jump like this suggests that the demand the CEO was talking about isn't just real, it's hitting a major inflection point.
Okay. A 42% pop is a powerful headline. I get it. But what's actually fueling that engine? Where is this all coming from? Well, this slide tells the whole story. The growth is coming directly from the heart of the AI boom. You see that AI workloads are driving 60% of their biggest, most important deals. But I want you to look even closer. It's not just about landing new clients. Over 60% of their existing customers are spending more money. They're adding new services. That, right there, is the very definition of a sticky platform. It shows that customers aren't just renting space, they're expanding within the ecosystem, which creates this incredibly powerful competitive moat.
And because of that, they're projecting all of this strength forward. Based on those record bookings and the very clear demand drivers we just saw, this is the revenue target that management has laid out for the coming year. They're telling the entire market they expect to bring in over $10 billion. Now, this isn't just some casual forecast. This is a promise. It's a promise to Wall Street. And now, let's see how that promise stacks up against Wall Street's own blueprints.
Now, this is what's really interesting to me on this slide. It's the gap. See, Equinix isn't just trying to meet expectations. They're actively guiding higher than the consensus. You have all these analysts who cover this stock for a living, right? They build their complex models, they run their numbers, and they came up with an average of $10.085 billion. Management looked at that, and then they came out and guided above the high end of that range. That's a powerful signal. That's pure confidence. They believe the market is still underestimating their momentum.
Okay, that's a solid bull case. A very, very solid one. You've got record bookings, accelerating growth, a crystal clear link to the AI megatrend, and some really confident guidance. But a skyscraper that's built on a shaky foundation is gonna fall. And my job here is to find those tiny hairline cracks before they become major structural failures. And when I look at this earnings report, it is giving off some very confusing signals. And this is exactly where investors who only read the headlines can get themselves into some serious trouble.
So what is the real story here? I mean, how can both of these headlines possibly be true at the same time? You've got investing.com over here saying, nope, they missed earnings estimates for the quarter. But then you turn around and Benzinga is screaming, Equinix beat estimated earnings by over 65%. 65%. That's not just a beat, that's a demolition. This, right here, is exactly the kind of confusion that traps investors who just skim the headlines. On the surface, it's a flat-out contradiction. So to really figure out what in the world is going on, you have to do the work. You got to look past the flashy headlines and dig deep into the specific numbers, the specific metrics each of these outlets is reporting on.
Okay, let's break this down. Let's start with the standard number that everyone knows. If you look at GAAP, that's generally accepted accounting principles, which is the official audited accounting standard, well, they missed. It's really that simple. As reported by both RTT News and Investing.com, the company reported earnings per share of $2.69. The consensus estimate from the street was $3.71. That's not a small miss. That is a significant miss. By this metric, the company absolutely underperformed.
But, and this is the single most crucial point you have to understand for any REIT, you have to look beyond GAAP. It's not the whole story. The industry standard, the number that actually matters, is AFFO, or Adjusted Funds from Operations. Just think of it as the true cash earnings of the business because it strips out all the non-cash expenses like depreciation. And on that metric, the one Wall Street actually uses to value a company like Equinix, it wasn't just a beat, it was a total demolition. They delivered $8.91 per share against an estimate of just $5.38. That's the 65% beat we were talking about.
So what we have here are essentially two sets of books. And the reason for this is that standard GAAP accounting requires companies to deduct depreciation, which is a non-cash charge. Now, for a company whose entire business is owning these hugely expensive buildings full of servers, that depreciation charge massively distorts the real picture of cash generation. So AFFO adds that back in. It's complex, and you know what? That complexity in and of itself can be a risk. But let's talk about the crack that everyone can see no matter which accounting metric you prefer to use, and that's the valuation.
A price-to-earnings ratio that's knocking on the door of 80. Now, let's just put that in perspective for a second. The average PE for the entire S&P 500 is typically somewhere in the 20s. Even other high-flying, high-growth tech darlings often trade for a lot less than this. This is a sky-high valuation. It means you are paying a massive, massive premium for that growth story. The market has priced the stock for absolute utter perfection. Any stumble, any little sign of slowing growth, and this entire structure could come under some very serious pressure. There is zero margin for error baked into this price.
You know, that valuation point is a completely valid concern. An 80 PE ratio is not for the faint of heart, that's for sure. But here's the thing. A high PE can be justified if the company is an incredibly high-quality cash-generating machine. And the counterweight to that valuation risk is the dividend. That's the bedrock. That's the tangible, hard cash return that provides a solid floor for the investment. Hype can fade, narratives can change, but cash that hits your account, that is real.
$5.16 per share every single quarter. This is not a paper gain. This is not some hopeful projection for the future. This is the hard cash flowing directly from their operations, from all those data centers, right into shareholder accounts. It's the tangible result of all those AI deals and all those interconnections we talked about. You simply cannot argue with cash in hand.
And they didn't just hold the dividend steady, which would have been fine. They just raised it by another 10%. That, my friends, is a statement of pure, unadulterated confidence from the board of directors. Companies do not commit to a double-digit dividend hike unless they see a very strong, and more importantly, a very stable cash flow pipeline for the foreseeable future. What they're doing is signaling to the market that the growth we saw in the bookings number is sustainable enough to fund even bigger returns to shareholders.
11 straight years. Think about that. That's not a trend, that's a proven track record. Ever since they converted to a REIT back in 2015, the management team has made it a top priority to consistently return more capital to shareholders, year in and year out. Now, this isn't just about discipline, it's about building trust with the market. But that consistency is also tied directly to their corporate structure. And that structure, while it's fantastic for dividends, comes with its own unique set of rules and risks.
Right. Being a REIT isn't just a label you get to slap on the company name to sound important. It is a very specific tax designation that comes with a very strict set of rules straight from the IRS. And following these rules is what allows them to avoid paying corporate income tax, but it also dramatically limits a company's flexibility, and it basically forces their hand in how they manage their own capital.
Exactly. To get those massive tax breaks that come with being a REIT, Equinix has to follow a very strict playbook. And it's all based on the legal opinion from their counsel over at Sullivan & Worcester. Now, the single biggest rule is right here on this slide. They are legally mandated to pay out at least 90% of their taxable income as dividends. This is the very mechanism that forces that dividend growth streak we were just admiring. But here's the trade-off. It leaves very little cash left over for anything else. They can't build up a massive war chest for acquisitions or for R&D like a regular tech company could. It's a structure that is built for payouts, not for hoarding cash. And while that creates discipline, it also makes them way less flexible. If a downturn hits, they can't just slash the dividend to preserve cash as easily as a standard corporation could.
All right, we have run the stress test. We've examined all the load-bearing metrics, and we have scanned every inch of this thing for cracks in the foundation. We've looked at the powerful bull case, and we've examined the significant risks in the bear case. It is time for the verdict.
Okay, so the bull case is forged in the fire of this AI revolution. The demand is simply undeniable, the growth metrics are solid as steel, and this company is a truly critical piece of our global digital infrastructure. And that dividend provides a strong foundation of shareholder return. But the bear case is all about price and complexity. You are paying top dollar for a story that requires you to ignore standard accounting and to understand the specific nuances of REIT law. You're buying into a structure that is far less flexible than a standard corporation. So, is the price of admission for this story simply too high? And that is the multi-billion-dollar question, isn't it? The world is building a completely new digital reality, and Equinix owns the land and the buildings where that reality is going to live. The demand? That is not in question. The price is. So is this a cornerstone for your portfolio, a foundational asset you can build on for years to come? Or is it priced for a level of perfection that leaves absolutely no room for any error? That is the decision you have to make. Thanks for joining us on Iron Financial.
Disclaimer: everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.